Hey everyone. For those of you who don't know me, my name is Brad Thorne. I am the wealth advisor and managing partner at Avenor Wealth. Also, I grew up at Repo Road Church, so it holds a very near and dear place in my heart. When John originally called me and asked to do a seminar on some gifting strategies and some other pertinent financial related topics, I was extremely excited. I think that this is something people of all ages in the church need to hear. Some of these things will not apply to you. Some of them are age related and some of them are not. I believe John is going to go through, listen to this ahead of time. He's going to send out the link for this, and when you get it, check the body of the email, and it should give you some times for each topic that I'm going to cover today so that you can make sure you see the topics that you really need to know. One good example is I'm going to talk about qualified charitable distributions, and you need to be 70 and a half or older based on current IRS laws for that to apply to you. So you could skip that if you are, say, my age or in your 50s. But I would implore you to maybe briefly listen to it still. You can maybe jump ahead a little bit, but it's something that I'd love for you to be aware of for in the future. Now, of course, the rules could change, but as of now, it's a really good gifting strategy to the church or other charities. So that's a big part of what we'll cover. I'm going to share my screen here and let you see some of the other um, topics that I will cover here. As you can see, the number one, first and foremost, will be the gifting strategies. So qualified charitable distributions, gifting appreciated stock or other investments, gifting life insurance, and then donor advised funds, which I'll only touch on briefly because they can get complicated, but they're good for individuals and for charities themselves. So they cover a couple different purposes. Then we're going to go into a little bit of estate planning, just basic stuff, wills and trusts, life insurance, power of attorneys, and make sure that you guys understand that. I recommend everybody, really, no matter how old you are, as long as you're an adult, to take a look at these options. Most importantly, of course, is going to be your wills and your medical and financial power of attorney. But there are some certain situations where you might need to look into a trust. And then um, life insurance inside of that, everybody, not just most people, everybody needs to have some life insurance in place. And I'll go into that more later. And then third, just going to briefly touch on retirement planning, just 401ks, traditional and Roth, same with IRAs, and then just taxable brokerage accounts. So that's a little brief overview of what I'll be covering. And then we'll take a look at some stuff and accompanied with the email with the link in it from John, there will also be a couple approved pieces that you can read a little bit deeper. It will also have my contact information. So this is going to be 30,000 foot view on a lot of this stuff, and it may or may not apply to you. And if you don't have a financial advisor, I would say that you should get one. They can help no matter if you have $100,000 to your name, $10,000 to your name, or $10 million to your name. There's a place for a financial advisor in what I call your family board. So that would be financial advisor, CPA or tax advisor, estate attorney, those types of things. I think everybody should have at least some sort of that in their lives because there's always going to be things that pop up. But so it will have my contact information in it. So if you need somebody to talk to and you don't have one already, I would love to be that person for you. But of course, this is more educational. This has nothing to do with whether you should or shouldn't use me. This is just so that you guys know what's out there and how useful it can be. So with that being said, we'll dive right in, starting with qualified charitable distributions. So like I said earlier, you have to be 70 and a half for this to qualify, or for you to qualify to use these. But what it is whenever you take money out of a traditional 401k or an IRA, that money, because you got the tax deduction when you put it in and it grew tax deferred, whenever you take that money out, it is going to be taxable to you. However, when you do a QCD and you send it directly out of the IRA to a charity, a church, as long as it's a 501c3 charity company, then it will never, you still report it as coming out of your IRA, but it is not taxable. So that can be very useful as we're looking at 70 and a half or older. You are also RMDH, which stands for Required Minimum Distributions, which is where the IRS decides to tell you you have too much in here, it's time to take some out. They set a limit each year based on the balance of the previous year before and your age. There's a complicated formula for that, but they will tell you what that is. Your 401k company or your IRA custodian, whoever it is, will let you know what that is every year. And that just has to come out. So why I say that that's very important is if you, let's just say your required amount to take out is $60,000 a year. You're already gifting to the church, but all you need is $50,000 a year for you to live off of and do your gifting and anything like that. So that's an extra $10,000 they're going to make you take out that you don't really need. Now, of course, you can take that out and just stick that aside. But if you're already gifting to the church, what I would say is instead of taking it from the money you're taking out that you need to live off of or that you have sitting in the bank, you already have to take 10,000 out more. So take a portion of that or all, whatever your situation calls for, and send that directly to the church or any charity that you support because it satisfies your RMD. The money's out of the IRA. That's all the IRS cares about. But it's also not taxable to you. So you're not increasing your tax burden since you weren't taking custody of the money anyway. And yes, some people, what a lot of people do is they take it out, they report it as income because it came out of your IRA, and then they gift it to the church. Even though you still get the taxable amount and then the deduction, it's actually more not only efficient, but also more tax efficient for it to just go directly out. Not a lot of people know, I'd say not everyone knows that QCDs exist, but if you're already gifting and you have to take money out of your IRA, that is the best way to take care of that. Now, I do want to point out I am a financial planner and wealth advisor. I am not a CPA or a tax attorney, so I'm not constituting any advice. It all depends on your specific situation. You need to talk to your tax person and your financial planner if you have one and make sure that this makes sense for you. But it's a very good tool to know exists and that you can use and have in your tool belt to make sure that you're taking care of the things you need to take care of without increasing your tax burden potentially. So definitely something to explore. Number 2 in my list under gifting strategies is gifting appreciated stock or other investments. Reason why that can be extremely helpful is if you have non-IRA money and you own a stock, Apple, Microsoft, Amazon, whatever it is, and you bought it at 10,000 and it's now worth 15,000. If you sold it all to gift, then you're going to have $5,000 in capital gains. Short term, if you held it for less than a year, long term, if you held it for after. The short term is going to be income. That's how that's going to be taxed. But the long term, yes, it's at an advantaged rate. So 15% for most people. Once you get over 500,000 in income, it goes up to 20. And it's zero up to a certain limit based on whether you file jointly or single or anything like that, but it's not a super high number. So what you could do instead of selling it, taking the capital gains and then showing the contribution to the charity, you just gift the stock straight to the charity. Never, they can sell it because they're a charity. They don't have to pay tax anyway. You didn't have to pay any tax on the gains that you had on it. You gifted the money that you wanted to gift to the church. And of course, you don't have to gift all of it. You can gift just individual shares. and do it that way instead of having to pay those capital gains. You can avoid that, still tithe or do whatever whatever gifting you want to charities and to churches, without having to take any capital gains. It's a lot easier accounting wise to do it that way too, not just efficient for you, for your tax burden. Another thing to look at that a lot of people don't think about when gifting is life insurance. So if you have permanent life insurance, whole life, variable universal, there's several different kinds that have cash value. You can actually just gift that cash value to the church and it won't come out as income. Now there's some cost basis stuff you have to, look into, but you get your deduction on sending that money over, or you don't take the taxes, one of the two. You get it to the church and they can take it. Another way to use life insurance for gifting is to make the church or whatever charity or charities you want to support the beneficiary of your life insurance. If you've gotten to a point in your life to where you're doing well, you're going to have enough left over to meet your obligations for income, to pay final expenses, to go to your kids if you have any. If you don't, of course, it's even easier. Then just change the beneficiary on your life insurance to the church and let that be your gifting part from your estate. So that could be very advantageous and easy to do. And of course, it's with money that's left over. It can also be very important with that because life insurance, of course, is leveraged. You usually get more out of it at death than what you would put into it. And if you have an estate tax problem, which right now is a very high number, you have to be 13.5 or 13.6 million per spouse before you have an estate tax problem. So I think there's only 20,000 families across the entire United States that hit that threshold. But if you do have that problem, and that number can always be adjusted, there was talk before the big beautiful bill that might even drop to 1 million. Of course, that would affect a lot more people. So that could be an efficient way to get the money out of your estate. It doesn't pay to your heirs where it just goes to the charity or the church. Of course, all of these can be useful for that. So there's a lot of different things that can be used, but all of them very helpful, just small nuanced stuff that a lot of people just don't know about. So that's why John wanted us to do this call. It's just some raise awareness for some situations that might help you on taxes while also helping the church and any other charities you support. The last piece in gifting is donor advised funds. So a lot of people don't know who they want to gift to right away, especially if they have a tax issue and you need to stick, like if you own a business or something. It can even be for individuals, but if you own a business and you have a lot of income and you need tax deductions, whether those are expenses from the business or your own personal stuff, you can sometimes, toward the end of the year, hey, I just got to get this money out. My tax person told me I need to make a donation of $20,000. I don't know who I want to send it to yet, but I need to get it out and I need to do it fast before the end of the year. Donor advised funds are set up to where you get the deduction when you put money into the donor advised fund. From there, money can be sent out at any time in the future, as long as it is to a qualified 501c3 charity. So churches, Habitat for Humanity, Carpenter's Table, whatever. You can also, you can gift stock into it. You can gift real assets like jewelry, collectibles, real estate even. Of course, there's more administrative work with that. But they're also cheap. A lot of people, and it's more wealthy families, found private foundations in the past. Those are expensive to set up and to administer. These do the same thing, but it's done in a much cheaper and simpler way, and anybody can have them. I had a family that has one with their last name, donor advised fund. That's just what they call it. You can be as creative and name it whatever you want. And he would gift into it at the end of every year, and then as we go throughout the year, he'd send it out to different charities. and it can be invested while it's sitting there. That's the other beautiful thing. It's not doing nothing. You can gift it, let it grow outside of your taxable situation, especially if it's stock that pays dividends and that's creating taxes. Gift it into but you know you're going to give that to charities. Well, just put it into the donor advised fund, let it grow, and then send it out whenever you want to at a later date. There's so many things you can do with it. It can also be useful for a charity itself for people to gift into for a church's foundation or endowment or building fund or whatever. So there's a bunch of different uses for those, but it's a really good option. And again, I or most financial advisors, I won't say all do that, but we can help you understand how that could work for your particular situation. So that kind of wraps up the gifting strategies. And again, this is a lot of information, and I'm kind of throwing it at you relatively fast. You obviously, in this setting, don't have the opportunity to ask questions. So please reach out to me or your financial advisor or tax person and get more information. They're very useful strategies that most advisors, I would say for QCDs, appreciated stock and life insurance, all are knowledgeable with that. Donor advised funds are probably a smaller number, but they are gaining popularity. So feel free to reach out to somebody to get more information. Also, this is broad in the fact that your particular situation may not make sense or may make more sense, and you need to run it through how you sit. So please do your research, ask me any questions that you have, and I can help point you in the right direction. The next topic that is extremely important is estate planning. This is something that people think about most of the time toward the end of their life. That's just when it becomes pertinent. That's just when people start thinking about it because they're coming to terms with their own mortality and those types of things, and knowing that I want to make sure my kids get what I want them to get, or charities or anything. But it's important to do now, at any time in your life. As soon as you become an adult and are out on your own, I think it's extremely important to have a basic will, living will, last will and testament. And there's a whole bunch of different, or a couple different things inside of those, but they give instructions for what your assets do, sometimes while you're still alive, in the case of the living will, and something were to happen to you, or in the last will and testament once you pass away. Because if you don't have one, it's more likely that your family will fight over who gets what. If you don't have any family or next of kin that the state can reach, then they will decide what happens to your money. Nobody wants that. They're going to mishandle that, just like every government ever has always mishandled funds. So if you want to avoid that, I think that's important. It's also really good for loved ones to just make it easier on them. Especially if you have young kids, what you can do is you can name people to be guardians of your kids. There's so many things in estate planning that are useful at 20 years old. So I think it's extremely important. Of course, you can get more nuanced and go into trusts. The good thing about trusts is they avoid probate. So they don't even have to go through the court system. If it's named in the trust, and then of course you make your will a pour over will, so that everything that's not titled in the trust will go to the trust at death, and it can take care of that kind of stuff. So that is extremely helpful. But again, those are a little bit more expensive and a lot more nuanced. So they are not for everybody. But again, I do want that to be out there so that you're aware that they're there. Um, Especially if you have somebody in your family special needs, a special needs trust can help make sure that somebody's designated, the money is designated, and somebody is designated to make sure the money takes care of that person once you're gone, especially if you're the primary caretaker of that child or person. So very important things that can be done with wills and trusts. I'm going to skip over life insurance next on and cover that after power of attorneys, medical and financial. A lot of times you hear durable power of attorney when talking about financial. Um, why this is important is if you are still alive but you're incapacitated, this gives somebody legal authority to make decisions for you. Ideally, inside of that medical power of attorney, you're also, you're going to say what you want done. With the medical in particular, if you don't want to be resuscitated or any extensive life saving measures taken based on your situation, if you have cancer or any type of other terrible disease and you just if something happens, you just want it to be done. Um, you can just have that stated for the person who is your medical power of attorney to take care of. And I know that this topic, estate planning in general, is very morbid and it's not easy or fun to think about, but it's very important. It's part of your financial life and just your life in general. So I recommend getting one set up. And you can do them online with trustandwill.com, LegalZoom. I recommend using an attorney. It is a little bit more expensive, but they can point you in the right direction based on your specific situation. But yes, that's an added cost. So there are some cheaper ways to do it. Quick little thing that I do know, if you use Fifth Third Bank, trustandwill.com is free. All I have through them is an auto loan and it's still counted. I'm able to use that to create a basic will and POAs inside of that for my wife and I. Again, I'm in my 30s, but we're doing that because it's very important. It just makes things easier, especially if something happens. It can make sure that what you want done is done. With the financial power of attorney part or the durable, there is a springing where it only happens when you're incapacitated. As you're aging, durable makes a lot of sense because there may be situations where technically you're not incapacitated, but you're not in your right mind and they can act for you. But so I usually recommend that. Springing is as soon as you're incapacitated, they can now act. But again, it makes sure that they can get into your money to take care of you while something has happened. A lot of times they try to go to the bank to take money out to pay for your care. If you don't have that power of attorney, they can't do that. So it can be a huge hindrance to make sure you're getting the care that you need. Um, and I say whether that's care because you're, incapacitated or in the hospital, but it could just be you're out of the country and something happened to you. It's a little bit easier now with the internet to where that's not quite as important. But there are situations where having somebody with financial power of attorney can be a huge help. So definitely things I implore people of all ages to look at. They're very important. Again, ask me if you have more questions. Another part of estate planning, we talked about it gifting wise, but I want to talk about it in a different way, is life insurance. Of course, if you're young, you have kids, or even a wife that depends on you, or a husband that depends on you, you're the breadwinner, um, you need to have life insurance. And a lot of people say, oh, well, I have it. I've got some through my work. For one, usually that's not enough. It's either going to be a small amount or a multiple of your salary. Well, that's great. But if you pass away and they only cover 2 years of your salary, the person you've left behind or the kids you've left behind, they're going to live a lot longer than that, hopefully. And that's not enough. They're also still going to have their mortgage. What I usually recommend is you have the balance of your mortgage, 5 years of income, plus any other expenses or education. If you want to go ahead and use that as a way, if something were to happen to you early, to make sure your kids get a good education. Um, the really easy way is a lot of people say 7 to 8 times your salary. So again, talk to a financial professional about how much you really need. But the other part with having it through work, you don't own it. If you leave, sometimes it's portable and you can take it with you. Most of the time it's not. And two, not only can the company just decide they don't want to offer that to their employees anymore, and at which point 10 years down the road, you're older and it's going to cost you more to get this insurance. You didn't lock in the price when you were younger. Or let's say you have a heart attack, but you survive. The company can say you're no longer eligible. So I highly recommend having some personal insurance that you own. Again, term life insurance is going to be the cheapest, but it only lasts for a specific term, 10, 20, 30 years most of the time. Of course, when you're young, it can cost you nothing. And again, I don't mind sharing my personal beliefs. I was 28 years old when I took out a $1 million life insurance policy on myself just in case something were to happen to me, and it cost me $50 a month. It's not very expensive. Did a quote for somebody my age, early 30s, recently for 250,000, and it cost them $20 a month. So I've seen for a female, it's going to be cheaper. I've seen $15 a month. So it's very important and very easy to do. Then there are permanent life insurance, whole, universal, variable, universal, um, whole multitude of options. There's some with long-term care riders on it that you can use to accelerate while you're still alive and take care of your long-term care, while also still having a death benefit. Very, very helpful. Especially, I would say the sweet spot for that is in your 50s, but we can look at it for all ages. Now, you need to be insurable with any type of life insurance. So there are, specific situations you need to make sure it works for you. But I recommend term for everybody at least, but I recommend having some permanent as well. Even if it's a small $25,000 policy to take care of your final expenses when you pass. Um, that's very easy, wouldn't cost you a whole lot, but it would go as long as you're alive. There are some situations where it may not if it's a variable and it's not performing well, but that's too deep down the rabbit hole. But yeah, that can be very easily, and any death benefit proceeds from life insurance are completely tax free to whoever they go to. Most of the time, there are some situations where that doesn't apply as well, but it's pretty rare. It depends on specific stuff, but so it's a very efficient way not only to take care of final expenses, but to pass money on to your kids. And like I said, there's leverage in it. So you're going to put in less money than it's worth, especially right off the bat if something were to happen to you. And the reason why I recommend term if you're young is it's cheap, especially if you have kids. I know how expensive that can be, um, buying your first house, all that stuff. But we're not guaranteed tomorrow. So it's very important to make sure that your loved ones are taken care of if something were to happen to you. Um, I recently had a lady who was in good health, passed away at 56 years old. And she thankfully had life insurance. Her kids had no problem being able to afford a really nice ceremony for her. And now they get to set money away for their kids, for themselves, for retirement. If they stay the course without changing much about their situation from before they received this, they really won't ever have to worry about money again. So it can be very important to help with loved ones, kids especially, of course, in the future. So highly recommend life insurance. Everybody should have a policy of their own. Um, Now, the third and final main topic is going to be retirement planning, um, which would be your 401k at work. There's traditional and Roth, traditional and Roth IRAs, 403bs, 457s, 401as in some situations. Those are rare, but they're out there. So many different, types of vehicles, deferred compensation, all that kind of stuff. But things that I want you, especially the young people, of course, to be aware of. Just a real quick, brief overview. Any traditional 401k or traditional IRA, any money you put into it is tax deductible in that year that you made the contribution. Grows tax deferred, and then any money you take out in retirement to live off of is going to be taxable as income in that year that you take it out. The thought behind that is at that time you're not working anymore, so you are in a lower tax bracket. Now, I don't know what tax brackets are going to do in the future. I think most people would agree the odds are taxes are going to be higher in the future. percentages and bracket wise. Doesn't mean it will be for your situation when you retire. Um, so gaining popularity is Roth IRAs, and now there's Roth 401ks, where any money you put into it is after tax. You don't get a tax deduction, but it's tax deferred. It's actually tax free. You don't pay taxes as it grows, produces dividends, anything like that. And then when you take it out, it's tax free, unless they change the tax code, which I don't anticipate happening, because the people in power now, and I say empowered by presidents, Congress, Senate, mostly Congress and Senate, they're worried about tax dollars now because they don't know how long they're going to be in there. So actually, they kind of rather you pay the tax now when you do a Roth 401k or IRA, but it also benefits you in the future. Tax Roth money, because it's not taxable, is going to go a lot further. I typically recommend it. It's almost a piece too of estate planning. That's the last bit of money that I want you to use, because as you get down to your last dollars, if you're spending money down quickly, tax-free money is going to go a lot further. The other benefit is Roth money that is passed on to your kids. Spouses, it just becomes theirs. Same with the traditional, but for kids especially, it's still tax-free to them. Inherited IRAs, traditional and Roth, they have to be taken out in 10 years. So they will have to take the money out in 10 years. But in the traditional one that they received from you, traditional inherited IRA, they still have to pay tax on it when they take it out in those 10 years. The Roth, it's not. So I usually recommend you wait that. If you've received an inherited Roth, you let it grow as long as you possibly can to the end of that 10 years and then take it out. There were stretch IRA rules. But they've gotten rid of those now. So I think it's going to be a really good estate thing in the future. That's what I'm using it as for a lot of my clients. One quick note: if you're retired and you've accumulated a lot of money in your IRA or your 401k that may now be rolled out into an IRA, is to do Roth conversions. You can convert traditional IRA or 401k money to Roth. Whatever you convert is taxable in that year. And there's some other rules that we need to talk about if you're wanting to do that. But it can help reduce your R&D amount, gets more money tax-free for you later, and then for your heirs whenever that happens. So there's a lot of benefits to it. But we need to loop in your tax advisor, especially with this, to make sure that we're getting that covered. There's a lot of nuance with that, but it is something I want everyone to be aware of that's out there. And then third, there are taxable brokerage accounts, which is just a normal investment account that's outside of any IRA. It's not considered qualified. So any dividends you receive in it are taxable to you in that year. Any capital gains from selling it that you get, taxable in that year, but you can get the money out anytime you want. With the traditional IRA and 401k, take money out before 59 and a half, you have to pay a 10% penalty on top of the taxes. With the taxable account, you don't. So that's another way to accumulate some savings. The other thing I like about having all three, taxable, Roth, and traditional, is everybody talks about diversification. When you're talking about investments, don't put all your eggs in one basket. I agree in tax diversification also. It's a big thing I preach to my clients, having money in all three of those buckets. There's a lot of strategies that you can use with that. And again, like I talked about earlier with gifting, any of those appreciated stocks or mutual funds or ETFs or bonds or whatever it is that you have in those accounts, that could be part of your gift. Just gift them directly to the church. Then you never have to assume the tax liability. And then the church doesn't either because they're a not taxable entity. So a lot of really good things that you can use, and having all three buckets of money gives you a lot of opportunity to do that. Now, I know we've covered a lot. The whole point of this was just to get it out there. Since it's recorded, you can go back and listen to certain parts that you felt pertain to you a lot more, go through them in pieces. John will have them, sectioned out so you know where to look. But so it's a lot of information. So go through it slowly. And again, you'll have my contact information and you'll have a couple pieces to read that, of course, you can read at your own pace. That might make things a little bit easier for you. But reach out if you have any questions. And John has been in the industry as an advisor before. He can help you too. I don't mean to throw that on him. He may be mad at me, but I know he's a super. He'd love to help anybody, so he can always help too. Of course, he's not actively practicing, I don't think, to my knowledge. So, but he's very knowledgeable and he knows. That's why he put this together. Um, it coincides with stewardship journey that you guys are going on. It helps you as individuals in your financial lives and situations. I'm really glad he asked me to do this. And like I said, this church means a lot to me and all the people in it. So I'm more than happy to help in any capacity. Now, hopefully this helped. And then later, if you need anything from me or have specific questions, please reach out. Like I said, I know it's a lot of information. Take your time to digest it, and it's something that I hope will help enrich your situation and also the church. I think with everything going on in the world, Christianity, Christians, the church, it's all very important. It's always been important, but I feel like now more than ever. And this is a good way to make sure that the church is in a good financial situation. And you guys are already doing that. So what this was just to give you an idea, especially on the gifting part, of how to do it more efficiently for you. You're already doing it. The church is already being benefited. How can we benefit yourself while doing it? One other thing I want to mention with the gifting is next year, typically if you do the standard deduction on your taxes, you can't deduct what you put in. Or what you gift to charities. They are, even if you take the standard deduction, allowing you to deduct $1,000 per person. So if you're married, it's 2,000, even with taking the standard deduction. So that could be very helpful. I'm pretty sure that starts next year. So that could be helpful just in general. But again, if you're RMD age, those QCBs will be huge. So definitely something for you to explore. Again, I'm here to help, and so is John. So please take your time and understand it, and we'll go from there. But I'm really glad that I was able to do this for everybody. I hope everybody's well. Happy Thanksgiving, Merry Christmas, Happy New Year, all the stuff that's coming out or coming up. I love everybody, even if I don't know you. God commands us to go out and love and to evangelize and to spread the word. So anytime you need anything, even if it's not finance related, please reach out. But thanks, everybody.